Good day and welcome to our webinar for September 2024. I'd just like to begin by making an observation that there were three major areas of uncertainty for investors at the beginning of this year, at the beginning of 2024. They were the outcome of the South African election, the US election, and the outcome of the Ukraine conflict. At the beginning of the year, all three of these areas were very difficult to assess. Each could have had a significant positive or negative impact on markets. Now, 9 months later, the uncertainty in all three of these areas has been significantly reduced. All moved markedly towards positive outcomes for the markets. The new Government of National Unity still has uncertainties, but it is a massive improvement on what we had before, and there is definitely some signs of progress. The war in Ukraine has moved sharply in favor of that country and against Russia, so things are looking pretty good there, which we'll look at in a moment. And then, of course, the US election has changed. The outcome, the potential outcome has changed significantly since Joe Biden retired from the election and it was taken over by Kamala Harris. So that has swung markedly in favor of the Democrats since the beginning of the year. So all three of these areas have moved in favor of equity markets, and that is through reduced uncertainty. Okay, let's take a look at America. The American Monetary Policy Committee's decision to hold rates unchanged in July has been much criticized. There are quite a few people in America that fear that the American economy is actually headed back into recession. The latest jobs data was a little bit concerning, with only 114,000 jobs created in July. And there's been some poor manufacturing data as well. Investors naturally became a bit nervous, and the S&P corrected 8.5%. If you look on your screen here, you can see that we gave you a warning by a tweet on the 10th of July and suggested that the market would correct. It then did this correction. As you can see, it took the markets down about 8.5%. But the question you really have to ask yourself is the American economy really in such bad shape? Some economists, like David Rosenberg, said it is already too late, while Wharton's Professor Jeremy Siegel has been urging the Fed to cut 75 basis points from interest rates, which would be radical. But I see that he has now retracted that suggestion. The unemployment rate, of course, has ticked up to 4.3%, but historically that is still very low. In our view, the sharp fall in the S&P 500, this sharp fall of 8.5%, occurred mostly because it had gone up too far, too fast in the previous 3 months. So some kind of correction was overdue, technically. As more economic data comes out, the economy will soon be shown to be fine, we feel. It may be a little cooler than previously expected, but that, after all, is the objective of raising interest rates. The Monetary Policy Committee's decision to hold rates, we believe, will turn out to be correct. Jerome Powell addressed the conference at Jackson Hole, and his remarks were pretty positive for equities. He confirmed market expectations that interest rates will begin falling from September. Now the only question really is whether it will be 25 or 50 basis points in September. The US economy grew by 2.8% in the second quarter of this year, well above estimates. Growth was boosted by consumer spending, and companies have been building up stock levels. Private consumption expenditure was up 2.3%, well ahead of the first quarter's 1.5%. And a big part of that was a 5.2% increase in defense spending, which is obviously linked to the war in Ukraine. Retail spending was up by 1% in July, well ahead of expectations of 0.3%. Consumers are clearly still supporting growth, And what is most noticeable is that they have been buying motor vehicles. These are big ticket items that consumers don't usually buy unless they're feeling very comfortable financially. So this does not look like an economy that is headed into recession. So what happened? Well, we think that AI stocks, artificial intelligence stocks particularly, went up too far, too fast. And then they corrected back to more reasonable levels. Meanwhile, the Fed's favorite indicator of inflation, the PCE index, fell to 2.6%. And that obviously improves the probability that rates will be cut in September. And so now we're looking at the second quarter. There are only 7 S&P 500 companies left still to report on their profits for the second quarter. So far, on average, profits have grown by 13% and sales have grown by 5.5%, which is well ahead of expectations. About 80% of companies in the S&P 500 beat their guidance for the second quarter. If there is a recession coming, it is yet to hit S&P 500 company earnings. We look at the chart. You can see that there's clearly been some profit taking at this high level, especially yesterday in the stock market when Wall Street fell by 2.12%. We do not believe that this is the beginning of a downward trend. We do not even really think that another correction is likely. However, there is the possibility, technically, that this is a double top, as you see here. We feel that this is fairly unlikely. We do think that October this year could see increased investor risk because investors are always nervous in October month. But we still anticipate that the S&P 500 will break to a new record high by the end of the year. All right, looking at America generally, one thing that we have been watching for many years is the level of debt in America, especially government debt. And quite frankly, it's reaching alarming levels. In July, just in July month, the debt was increased by $243.7 billion. This took the shortfall for the whole year to $1.52 trillion. So far this year, the American government has spent $1.5 trillion more than it's brought in tax revenue. So now the total government debt is standing at $35.15 trillion. That is an absolutely enormous number, which clearly cannot be reduced by cutting government costs or boosting income. So our view is that sooner or later it will be resolved by either an inflationary or a deflationary crash. Most probably a deflationary crash similar to what happened in 1929. At that time, the Dow Jones fell to just 11% of its peak value. In other words, it offloaded 89% of its value in about 2.5 years. We do not believe that a crash is imminent, but we are almost certain that it eventually will come. And private investors need to keep this in the back of their minds. The US economy has been borrowing from the future to pay for current growth. America is kind of like a rich man that has fallen on hard times. She has a strong aversion to hard work. She's been living off her credit rating. And she has a taste for expensive imported products that she can no longer afford. At some point, the piper must be paid. Of course, governments control the size and growth of their money supplies, and they can use quantitative easing to increase the money supply and use that money to pay off debt. The usual method of evaluating a company's debt is to express that debt as a percentage of gross domestic product. In America, US government debt is now 99% of GDP. And that is expected to rise to 122% in the next decade. This compares with South Africa's debt, which is currently around 73.4% of GDP and is considered excessive. Of course, America has an advantage. About 60% of world trade is conducted in US dollars, and some countries even use the US dollar as their official currency. All countries have to hold US dollars to pay for oil, what is called a petrodollar. This means that the US can get away with considerable quantitative easing, at least in the short term. The problem is that recessions have become politically impossible in America. Obviously, reducing government spending or increasing taxes is highly unpopular. So since 2001, no government in America has reduced the debt. And the debt is now 3 times as large as it was in 2001 and about 10 times as large as it was in 1987. The boom conditions in the 1920s were sustained by massive technological advances, particularly the development of mass-produced motor cars and the widespread use of telephones. Today, artificial intelligence, humanoid robots, and the slow switch to solar power are driving markets. All three promise to have massive increases in productivity. They all are going to produce increases in productivity. But are they enough to continue driving the market to new record highs? If you look at our chart here, you'll see that the S&P 500 has recovered almost all of the ground that it lost in this major correction. And on Friday last week, it closed just 0.33%. Here, before the Labor Day holiday, it closed just 0.33% below its all-time record high, which was this level over here. So it's very, very close. As I pointed out earlier, we tweeted that some kind of correction was inevitable on the 14th of August. But now we expect the S&P 500 to continue going up. In other words, the profit taking, once it's done, should resolve itself into a new upward trend, and we will see new record highs. Note this period over here on the chart where we had 8 days where the S&P 500 went up. It went up consecutively for 8 days. That is very, very unusual. So if you see that in the S&P 500, you can be pretty certain that on the 9th day it will fall, as it did. So obviously there was a lot of bullish sentiment and some kind of correction was inevitable. So we are looking also here at a V bottom, which is another indication of excessive bullishness. We believe that bullishness is still in the market and that there's still a great appetite to buy the dips. So we expect the S&P 500 to get to a new record high in due course. That's really the message. Okay, let's turn our attention to Ukraine. Since we spoke to you last, there has been, of course, this incursion into the Kursk area by Ukrainian army. It seems to have been very well planned and executed. The Russians and NATO alike were taken by complete surprise. UK has penetrated about 35 kilometers into Russia, and they've taken control of 100 towns, and I understand about 1,300 square kilometers of Russian territory. They've taken more than 2,000 Russian troops captive. And of course the goal here is to draw Russian troops away from the Donbass, where Russia has been making incremental gains. Also, this incursion could act as a bargaining chip in any future negotiations for peace. Russia seems to be completely incapable of coming up with an effective solution to the problem. They have not been able to throw the Ukrainians out of Kursk, and now they've been there for a month. And I think a major factor here has been the Ukrainian control of the air. Many vehicles have been seen moving into the Kursk area without any fear of drones. So the Ukrainians have been moving in armored vehicles, tanks, and artillery into the Kursk area, and they do not appear to be afraid of drones. This must mean that Ukraine has got great confidence in their anti-drone capabilities in that area. Or perhaps the Russians just simply do not have enough drones in that area to attack. But it looks to us like more and more that Ukraine intends to hold its position in Kursk. It is in effect creating a buffer zone inside Russia, which it is expanding. Obviously, NATO weapons have been used to execute this incursion and will continue to be used. So the next logical step from our perspective would be possibly to mount a similar incursion into Crimea. And that would be devastating for Putin. The Kursk incursion has already damaged Putin's standing inside Russia. It is putting unsustainable pressure on him to do something effective. Hundreds of thousands of Russians have been evacuated from the Kursk area, and of course they have moved into other parts of Russia and are talking about what is going on. It's impossible now for Putin to keep a lid of secrecy on what is happening. So he is facing a rebellion from his own oligarchs and also from the Russian people. And it is now looking more and more likely that Trump will lose the elections in November. So that will not come to his rescue, we think. NATO sanctions have been destroying the Russian economy. Food inflation has become a major problem. Suppliers of beer, bread, and dairy products and chocolate have said that those products are going to go up 40% next month. If this happens, there could be food riots. At the same time, Ukraine has exported 64 million tons of products through the Black Sea corridor. The Russian Black Sea fleet has been powerless to stop them. It has lost about 1/3 of its ships, mostly to Ukrainian sea drones. And what is left is cowering far away. We believe that things are coming to a head in Ukraine, probably before the end of this year. Obviously, a resolution of the Ukraine war can only be good for equity markets. All right, let's turn our attention now to South Africa. We begin in the sort of political area. The Government of National Unity is starting to face some major tests now, particularly with the national health insurance issue. Business Unity South Africa says it will not sign off on the NHI in its current form. Of course, all the parties, including the ANC and all the parties in South Africa, agree on the need for healthcare for everyone. They just can't quite agree on how that should be done. The DA has been opposed to the NHI as unaffordable for a long time. Ramaphosa signed it into law before the election, but we think that was mainly an effort to try and attract some populist vote. Now, of course, if they compromise on the NHI, they will be seen as selling out to the DA, and that's a concern for them, of course. The Government of National Unity is already having a big impact on foreign domestic investment. Standard Bank says 95% of foreign investors expect to invest further into this country. There's a great enthusiasm for South African bonds and equities. And of course, overseas there's been a major shift towards risk on as the S&P and other markets around the world rise. All of this is being reflected in the Rand. So I'd like to just quickly take a look at that Rand chart here. Okay, this is the chart of the Rand against the US dollar. Of course, it's inverted, so when the chart goes up, it means that the Rand is weakening. When it comes down, it means the Rand is strengthening against the dollar. Some time ago, about 2 or 3 months ago, we drew your attention to the fact that the Rand was oscillating in what is known as a triangle. So you can see a triangle is bounded on the top by a descending trend line and on the bottom by a rising trend line. And what it actually indicates is that the market is moving towards a point of less uncertainty. So you can see the uncertainty was very high here at the beginning of the triangle, and it diminished by this time of this touch point here, diminished further over here, further and further and further and further, and eventually broke down through the lower trend line, which shows that the Rand has headed into a new area of strength. Obviously, that is partly due to the shift towards risk on in overseas markets, but also partly due to the improved political situation and political stability in this country. So we believe that the rand will continue to strengthen, and that is obviously very good for this country. It helps inflation to stay low, and particularly it has been helping us to have cheaper fuel. So petrol price has been going down consistently for the last 3 or 4 months, and that is having a big impact in South Africa. It's putting more money into everybody's pocket. All right. So we expect this strengthening of the rand to continue for the meantime. Finally, on the political scene, we've had this defection of Floyd Shivambu from the EFF to MK. It seems to us that the EFF is crumbling as a populist faction, and we anticipate that sooner or later MK and EFF will probably combine forces to provide a united opposition. Both parties do not appear to have any serious organizational skills, and that can be a big problem for a political party. They both have internal conflicts which have damaged their image. But the election result was clear. South Africans don't want a populist extremism, and nothing can go around that. All right, let's look at the economy now. South African economy. Inflation in July month came down sharply to 4.6% from June's 5.1%. This was mainly due to a sharp drop in food inflation, as well as obviously lower fuel costs. The PPI also dropped to 4.2%, which is now well below last year's average of 6.7%. Of course, the goal of the Monetary Policy Committee for some time has been to get inflation down to the midpoint of the target range, which is 4.5%. And we are now almost there. Interest rates can now start coming down. In September, we are expecting either 25 or 50 basis points down. Citibank is predicting that gross domestic product growth in South Africa will be 2% in 2025 due to the GNU and the end of load shedding. They expect inflation to come in at 4.1% next year and interest rates to come down by 0.75% before the end of this year. This compares with the IMF, which expects growth next year to be 1.2%, and Standard Bank, which says growth will be 1.8%, and ABSA, which says it will be 2%, like Citibank. We believe that growth could actually be even higher than these numbers. The South African economy is like a light switch. It's either on or off, and right now it is turning on. Retail sales for the year to the 30th of June were up 4.1%, well ahead of expectations. Sales at general dealers, which of course includes supermarkets, rose by 7.3%. That shows that consumers are spending. They're out there. The end of load shedding has had quite a significant effect, and the sharp drop in petrol prices has put money into everybody's pocket. Interest rates are about to begin falling, and that of course will mean reduced bond repayments. So people are feeling a little bit more optimistic. That's really what I'm saying. Mining production in the second quarter was down 1%, and so far this year it's down 3.5% compared to last year. Iron ore was down in the quarter by 12%, and coal was down 2.6%. The general decline in commodity prices is impacting the economy. South Africa, of course, is primarily a producer and exporter of raw materials. Significant retrenchments have taken place in the platinum group's metal sector, and more will follow, we think. There have also been quite a lot of shafts closed in the mining sector there. There have, of course, been bottlenecks in rail transport and at the ports, and they have been a major impediment, and that has caused mines like Kumba to revise their production guidance for the year. All right, debt busters. The financial planning people have said that disposable income has dropped by 44% over the last 8 years, according to their figures. This is due obviously to high interest rates, high fuel costs, load shedding, etc., etc. The cost of electricity has tripled since 2016. And what they say is that, payday loans are being taken up by 80% of people who apply for debt counseling. Interest on these types of loans is cripplingly high. PayCurve says that about 20% of salaried employees are now having to borrow from their next salary to get through the month. So they're taking payday loans. That's what they're saying. South Africans, on average, are currently spending about 62% of their income just on interest. That is unsustainable. But BankServe says that take-home pay was up 5.9% in July from a year ago. And that is obviously also due to 5 months without load shedding. The Government of National Unity and Operation Vulindlela are having a major impact on the economy, and we expect that to continue and to accelerate. The unemployment level in South Africa has always been difficult to measure because of the informal sector in this country. Officially, the economy has created 1.8 million jobs in the last 32 months since the beginning of 2022. The problem is that during that same period, about 2.2 million adults have joined the workforce, mainly school leavers, of course. The result is that there are about 400,000 more people in South Africa without work than there were at the start of 2022. At the end of the second quarter of this year, there were 8.4 million people without work in this country. Low rates of growth that we have now cannot absorb all the school leavers that we produce each year. And we have one of the highest unemployment rates in the world at around 33.5%. To create enough jobs in the economy, we need the economy to grow by at least 3% per annum, and preferably more. For the past 10 years, it has managed only about half of that. So the situation has become worse and worse. Hopefully, the new Government of National Unity will work towards better growth rates. All right, Transnet was given 25 billion rand guarantee by the Treasury to help it pay for upgrading the ports. Particular attention will be paid to Durban, East London, and Kabaka. The motor industry exported 400,000 vehicles in 2023, despite the problems that they're having at the ports. Some of our ports are ranked the worst in the world for turnaround time. Transnet's financial problems are reminiscent of Eskom's. The CEO, Michelle Phillips, says that their interest cost alone is now around about R1 billion a month. The solution, of course, is to get the private sector involved in public-private partnerships. Eskom has said that load shedding is unlikely this summer. Coal power stations are just performing better. Unplanned outages are down to 12.4 gigs from last year's 16.4 gigs. The extra 4 gigs has been a huge boost for the economy. And there's another 2.4 gigs which will come online fairly soon as Medupi, Kusile and Kuiberg bring new units online. Stats South Africa says in their survey, they did a survey of 30,000 people to establish crime levels in the country. Only 28.5% of crimes are being reported to the police. This is a damning indictment of the police service in this country. South Africans have completely lost faith in their competence and in their ability to catch criminals. And the criminals also are completely blasé. They don't really care what the police do or don't do. Over the past 5 years, the survey indicates that there were 2.6 million cases of housebreaking or burglary. There were 67,000 murders. And 2/3 of the crimes involved firearms, so that's also very concerning. These statistics are very bad for foreign direct investment in South Africa. And they also tend to result in immigration. Skilled people leave this country because they don't like the crime rate. The ANC is really to blame for the collapse of policing in this country over the past 30 years. Okay, Investec says tax collections this year could be about 80 billion rand below what was budgeted. The tax that we collect comes from personal tax, which is about 40%, VAT, which is about 25%, and corporate tax, which is about 16%. The total amount budgeted to be collected is 1.86 billion. Of course, in the second half of this year, tax collections may be boosted by the fact that due to no load shedding, the economy is going to do better and profits will be higher. South Africa's government debt is at a very high level, and it has been difficult for us to raise cash for the electricity grid. The new transmission company needs about 14,000 kilometers of new transmission lines to bring the power from renewable areas to the major centers. So renewable, it's like solar farms and wind farms, need to be able to transport that electricity to the major centers. The transmission company needs about 400 billion rand to build new lines, but it's very difficult for them to raise funds. At the moment, only about 1,400 kilometers of line are being built every year, which means it will take decades for us to get through the backlog. Like Transnet, private-public partnerships may be the solution. All right, I'd like to just talk now a little bit about oil, or commodities, let's say. And I'd like to begin with the oil price. So just have a look at the chart here. You can see the oil price reached a high point over here, just under $100 per barrel. But it has since been going down, and I think that's a lot to do with the Biden administration. I think they put pressure on Saudi Arabia to keep oil prices low. And you can see yesterday the oil price dropped sharply down to $73, which is just about in line with this cycle low here. If it goes below that level, and by the way, this sharp drop in the oil price, it was one of the major factors in causing the 2.12% drop in the S&P 500 yesterday. So that's something to take into consideration. A lot of that fall was due to the oil price. But a falling oil price has an impact throughout the world on inflation rate, because it drops the petrol price for everybody right around the world, puts more cash into everyone's pockets. So in the longer term, it's quite bullish. Of course, the low oil price is also very good for the Democrats in their election bid this year, and it will help Harris to be elected. And of course, it's bad for Trump for the same reason, because high gas prices in America are perceived as being caused by economic mismanagement. So if gas prices come down in America, which they will undoubtedly do just before the election, then that's good for the incumbent. And the incumbent in this case is Biden, and obviously his vice president, Kamala Harris. Of course, low oil prices like this are also very bad for Russia, because Russia is one of the world's largest oil exporters. And so this makes it very difficult for them to continue financing their war in Ukraine. Here in South Africa, the petrol price has been falling steadily, and it should continue to do so. And the petrol price here is benefiting both from a stronger rand and the falling oil price. All right, I'd like to just now talk about gold, because we did talk about gold a while back. In March this year, we showed you a chart of the dollar price of gold. What I want to do is, let's put a bit more data. Here you can see this is a 5-year chart of the US dollar price of gold. And you can see this resistance level at $20.60. In March this year, in the confidential report, we pointed out to you that gold had broken up through that resistance. And we said there we expect a new upward trend. Well, that upward trend is progressing very strongly now. And last Thursday, in fact, gold hit a new record high of $2,526 per ounce. Of course, this means that some of the smart money in the world is looking for a safe haven. They buy gold because they want security. When they buy gold, of course, they are sacrificing the income which they could get from a US T-bill, which would be, say, 3.8% per annum. So why would they sacrifice that income? Because they want security. So that's interesting. And we drew this to your attention, and of course some of the gold shares have gone up very strongly as a result. Okay, let's talk about companies now. As a private investor, you should invest in solid blue chip shares. You should have at least a part of your wealth in solid blue chip shares, those which have a long-term track record of performing extremely well. One of those shares, and one which we've spoken many times about, is Capitec. I just want to put the long-term chart here on the screen. So this is Capitec. This is a semi-logarithmic chart. You can see that from the axis here, the x-axis. But way back here in March of 2002, you could have bought Capitec shares for 80 or 90 cents a share. Okay, this share closed on yesterday at 2,890 Rand a share. So it's gone from 80 or 90 cents to 2,890 Rand over that period of about 20 years, 22 years. That, I apologize, I knocked my microphone over. That is a diagonal share. It goes from the bottom left-hand corner of your screen to the top right-hand corner. We call these types of shares diagonals, and you can see here that right through the Zuma years, through the 2008 subprime crisis, right through all these things, this share just kept right on going up, and it's been paying good dividends every year as well. Last year it paid out 48.75 Rand just in dividends. So what an incredible investment, and you need to have some of those in your portfolio. All right, let's look at some other things here. Advotech. We have spoken about Advotech in the past. It's a share which we really like. It's obviously in the education business. It has 113 schools, 33 tertiary campuses, and 6 resourcing brands. In its results for the 6 months to the 30th of June this year, revenue was up 9% and headline earnings per share were up 16%. It's a very strong cash-generating business with a strong balance sheet. We added it to the winning shares list a while back. I just put a bit more data on the screen here. Yeah, that's where we added it to the winning shares list on the 14th of August. It was then 1975 cents a share, and it closed last night at 3,232 cents a share. So it's gone up extremely strongly. The gain is about 65% in just over a year. Okay, the next share I want to look at is Harmony. Harmony, of course, has been benefiting from the rising gold price. Just put a bit more data on the screen here. Maybe 2 years. We added it to the winning shares list over here. And this was on the 16th of November last year. So it's been on the winning shares list for just over a year, and it's gone up about 68% in that time. The thing about Harmony that you should understand is that it bought the Mponeng mine from Anglo a while back, and that was a huge risk because Mponeng is actually the deepest gold mine it's the deepest mine in the world. It goes down over 3,800 meters. In fact, they are mining 2,000 meters below sea level from the Highveld. So that's incredible. So down at those levels, the rock is very, very hot, and it actually doesn't behave like rock normally behaves. It's the surface temperature of the rock can be as high as 60 degrees Celsius. So that means that they have to have a huge crushed ice plant on the surface, which crushes ice 24 hours a day, pumps the crushed ice down to the bottom of the mine, where it obviously melts, and then they pump the water back up, refreeze the ice, and pump it down again. The only reason they do that is to keep the temperature down at the bottom of the mine cool enough for people to operate. But gold in South Africa is in conglomerate form. That means that it was laid down in an ancient seabed millions of years ago. And that seabed breaks the surface just south of Johannesburg, where you see all the mine dumps there, and it tips down towards the south at an angle of about 20 degrees. Now, of course, gold is a very heavy metal, so the further down, the deeper you go, the higher the grade that you get. And the Mponeng mine is now producing grades of as much as 6.11 grams per ton. And that is very, very good. So it has been a huge profit generator for Harmony and is now their main activity. Harmony just produced its results for the year to the 30th of June. Production was up 6% and costs were up 1%. That's always good. The headline earnings per share were 1,852 cents per share, which is more than double last year's 800 cents per share. Very strong chart. Obviously, because it's a commodity share, the chart is somewhat volatile, and we believe that this share will continue to go up as the gold price rises. Okay, Stadio. This is a competitor of Advtech, so they're also in the education business. They now got more than 50,000 students, and student numbers were up 10% in the 6 months to the 30th of June 2024. Their revenue increased by 16% and headline earnings per share were up 20%. This is a company with no debt and massive cash balances. They've got nearly 100 million rand in cash in the bank. People pay in advance for education. It's traditional. And that means that a company like this doesn't have stock, really not significant stock. It doesn't have a significant debtors book. So it actually has negative working capital. It is a very, very sound business opportunity, really. We added to the winning shares list on the 29th of June this year, just a couple of months ago. It was then 525 cents a share. Last night it closed here at 606. So it's gone up quite nicely in a very short space of time. This is one of those companies that we expect will benefit from the appointment of the Government of National Unity. So you need to look out for shares that will particularly benefit, and those will be companies that will benefit from an improving economy in this country. Okay, folks, well, that's about what I have for you this time. I hope that you found something of interest or value in my presentation, and we'll talk again next month on the first Wednesday in October. Otherwise, I'd just like to say thanks very much for listening to me. Thank you.